Hey, welcome back, my fellow investors. This is me, E.T. And remember, I'm not a financial advisor. I'm not your financial advisor. I'm just a self-taught investor who's always looking for ways to increase one's net worth. Now, what this video is about, it is about really the poor man's covered call. Really what the poor man's covered call is nothing more than a diagonal spread. But the slang name for it is poor man's covered call. Now, for any of you to get anything out of this video, you must understand the operations and what a covered call is. Okay, if you don't know that, this video is going to be useless. You might as well go ahead and stop. And I would definitely suggest check out some of my other videos or another YouTube video to learn about covered calls. So if you have an understanding of covered calls, this here is like graduating, going to the next step. A poor man's covered call or the diagonal covered call. So why a poor man's covered call over the covered call? Well, number one, it's going to require less capital and you can actually get a higher return on your investment, you know, when you look at the percentage basis. To give you an example of that, all right, back in November, cheat sheet here, back in November, the 30th of November, I wanted to get into XLE. XLE is the ETX for the energy sector. So at that particular time, the XLE was trading at $55.34 per share. So in order for me to get into it, to start writing covered calls, as you know, I would have to buy 100 shares. That would have been $5,534. Now with that, if I would have spent the $5,500, I could play one covered call, or I can go out and sell one contract. Now, this is the beauty of a poor man's covered call. The poor man's covered call for that same position, the XLE, I can actually go out and get a 2-year LEAP, long-term equity anticipation security. That's what a LEAP is. Now the LEAP, a 2-year LEAP, I can actually go out and get one for $13.50 or $1,350. Now, I can spend $1,350 and do the same thing and go out and sell one contract as if I owned 100 shares. Okay, so basically what you're doing with the LEAP is you're replicating the 100 shares, but it costs a lot less. Or if I wanted to, if I was going to spend $5,500 to buy 100 shares, I can actually, with the LEAP, the 2-year LEAP, actually get 4 contracts. I can go out and sell 4 contracts at the same price of getting one if I was going to do the traditional covered call. That's what I mean by a higher return on your investment on a percentage basis. Keep that in mind. Now, just like with everything, there's no, you know, the perfect option play. There are some downsides. Number one, you don't own the stock. You don't own the stock, you're basically leasing the stock. And because there is no stock ownership, you get no dividends. Remember, with a covered call, with you owning 100 shares, you're still going to be qualified for the dividends. More management is going to be required to manage this option play, because not only are you looking at the LEAP, you're also looking at your short position, the one that you wrote the covered call on or sold the covered call on, where you receive the premiums. So let's go over how to set up the covered calls. And realistically, this is how I am setting up all of my future covered calls. And before I get into this, let me just say this here. I was, for the last 2 years, I wrote a lot of covered calls, traditional covered calls. You know, in 2020, it made about $45,000. In 2021, it's just this past year, made $49,000. This year, I'm going to dedicate and I'm going to do a lot more poor man covered call plays. Now, these are the rules that I go by. This is my recommendation on how to set up a poor man's covered call. So let's go over that. All right. First of all, it's a 4-step process. Step number 1, you got to pick the stock. Step number 2, you got to buy the LEAP. Long-term equity anticipation security. That's what that LEAP is. Then you got to go out and you got to sell the covered call. This is your short position. And then step number 4, you have to manage your trade. Let's go over step 1. Step 1, pick the stop. Now, you can use any criteria that you want. Just through my own trial and error, I've decided this is what I'm going to use to pick the stop. Number 1, I am looking for a stock that's either in the Dow, the S&P 500, or I would go with an index or an ETF. And regardless of what you decide to go with, all of those stocks must be optional. Because if it's not optional, you can't do it. You can't even write a covered call off on it. So keep that in mind. All right. Now, let's go over step number 2, buying the leaps. All right. Step 2, buy the leaps. These are my criteria. Number 1, I want to make sure that the expiration date is at least 1 year out. Now, I know that you can go 6 months. The key is as long as your long position is further out than your short position, that's the key. But with me, I want to go with at least 1 year out. Ideally, I'm starting at the 2-year point. If I can go 2 years out, I'm going to go 2 years out. I'm going to go as far as I possibly can. All that's going to do is give you a little bit more protection, a lot more time to write more cover calls and get more premiums on. Also, I'm going to be looking to buy deep in the money, strike price. And in order to do that, I'm making sure that it is at least a 70 delta or higher. All right, deep in the money. And you want to buy that on a down day in the market, but also look at your charts. I keep mine simple. I use the Keltner channel. And what I do with the Keltner channel is, if you guys are familiar with it, it shows the resistance, shows the mid, and it shows the support. What I'm going to do, what I recommend anyone doing, is when you get ready to buy and set this up, make sure that the price of the stock is either at the mid or below. I would not enter into that trade if the price is actually above the mid of the Keltner channel. That's what I use. Or if nothing else, if you don't use the Keltner channel as a stock indicator so far as with charting, you can just take a look at a chart and see if it's near the support. If it's near support, you have a much better chance of overall success because it's more upward pressure than downward pressure. So near the support, keep that in mind. Let's go over step number 3. So step 3, you're going to write the covered call. Write the covered call is the same thing as sell the covered call. What you want to do is I would recommend that you sell that covered call on an up day when the market is up or that particular stock is up in price. I mean, the higher that it's up, the better. At this particular point, as it gets closer to that support, that's the ideal time. If it hits that support or it's over that support, that is the ideal time to write your covered call or sell your covered call. Make sure that you do it with, you sell it out of the money covered call. Out of the money, and the reason why I say out of the money, and you want to use at least at 30 delta or below. And the reason why is because, once again, this delta shows you the probability and the price movement. And then next, the expiration date. 1 week out if it offers weekly expirations, but no more than 45. Your initial cover call that you're going to write, you want to go stick within 1 week to 45 days. And the reason why is because if something happens during that time period and you need to adjust and roll, guess what? You have more time to work with. You can roll out. You'll have a little bit more options. You don't want to roll out so far in the future that you're going to be sitting on the sidelines monitoring all of that time. So stick between 1 week, the initial 1 week and 45 days. Then you can go out further than that if you have to manage that particular trade. Now with that takes us to number 4, which is managing the trade. And what you're going to manage this here. You're going to manage that cover call that you receive premiums on. This here, the cover call that you wrote, is your short position. The leap is your long position, all right? But regardless of the fact, once you write this, at this particular time, now you're going to focus on managing the trade. Step 4, manage that trade. You've written covered calls before, so you know exactly what I'm talking about. It's no difference with a poor man's covered call. The only distinguishing factors between a traditional covered call and a poor man's covered call is that we have this long position at the lead. Versus having that 100 shares, we have a leaps position. After that, everything else is the same. You write the covered call, you manage the covered call. And basically what you're managing your short position, the one that you wrote the covered call on. So just like with traditional covered calls, this is how you manage it. One of 4 choices. You can let it expire worthless. You know, if it expires worthless, you keep all of that premium. That's one of the advantages to letting it expire worthless. Or you can buy to close early. Normally what I look at in order to buy and close early, if I'm showing a 70% profitability of the premiums received, I may seriously consider buying to close early in order to lock in that profit. If I do that, and once I lock that profit in, guess what? At that particular point, I can just sit back and wait for the stock to rise some more and write another covered call, or I can possibly write another better covered call for the next expiration date. Or you can roll it. And you know what happens when you roll it. You can either roll it out in time, you can bring it up in time, you can roll it out for an increased price or a decreased price. All of that, how you're going to roll it is going to depend upon what's happening with that underlying stock in your short position. In other words, you'll take a look at both of those factors there to determine what's going to be best for you. And normally when I'm rolling, I am always looking to roll for a credit. Every now and then, you might have to roll for a debit, but for the most part, I'm looking to try to figure out how can I get a credit out of this? Or if nothing else, break even. Sometimes, yes, especially if you want to keep the position, yeah, you can roll it for a debit, sit on the sidelines and wait for your next entry. Now, last thing that you can possibly do, you can let it be assigned or exercised to you or away from you. That there is going to be really a choice based upon what's going on within that stock. For example, if it skyrocketed up and it just costs too much to buy to close it, you might want to just say, okay, I may want to go ahead and end this position. One thing I like about the poor man's covered call, let's just say you get into something and it rockets up, and all of a sudden it's just too expensive for you now to go ahead and buy to close. So what you can do is let it expire, let it be taken away from you, but as it rockets up, the price of your leaps also went up. So you're going to be closing out the position, but you may have lost on the short, but gained on the long. You got to look at the situation and determine what's going to be best for you. That's really the poor man's covered call in a nutshell. What I provided to you is a foundational knowledge of the poor man's covered call. If you really want to get into a lot more detail, to really start peeling that onion back so far as really looking at the deltas and to see whether or not there's a time value, what's the time value ratio. There's other videos on YouTube out there that would take you to the next level when it comes to the poor man's covered call. But if nothing else, this is laying the foundation to have you start looking at it, to possibly even also have you start dabbling with that poor man's covered call, because it's going to take less capital. It's just like the covered call, just takes less capital. You don't own the stock, but also you're going to get a higher return on your investment. So hopefully you found this information to be useful. If so, hit that like, subscribe, notification button. And as always, remember to save, invest, apply what you know, because knowledge is not power. It's the application of knowledge is power. I'll see you guys on the next video. And guys, the very next video that I'm going to do when it relates to the poor man's covered call, I will show you the 5 poor man's covered call that I'm currently working on. I have 5 open poor man's covered call position. Citicorp, XLE, IVR, which is Invesco Mortgage Capital, ChargePoint, and Riot. So the next video, probably within the next, look for it immediately. Probably I'll do it within the next couple of days, but I will go over each one of those, and so that way you can see whether or not I'm making money on this poor man's covered call. All right, guys, I'll see you on that video. Take care. Bye-bye.